Welcome to Yahoo Finance Live. I'm Shauna Smith along with Akiko Fujita. Let's get you up to speed on the market action. Investors waiting for signs of progress on the debt ceiling fight. You're looking at losses across the board. The Dow off nearly 300 points. S&P and Nasdaq both off. All three major averages all off just about 1% here. Markets pulling back on that lack of progress surrounding those debt talks. The biggest laggards in today's action, real estate, financials, and industrials leading to the downside.
And Shauna, we are focused on the debt ceiling talks there. House Speaker Kevin McCarthy sending Republican negotiators back to the White House today, but he says they are still hitting a snag, overspending. Yet he did say he's optimistic a deal can be made before the deadline. Joining us now is Congressman Henry Cuellar, Democrat from Texas. Congressman, it's good to talk to you today. You've got J.P. Morgan Chase now coming out and saying that the chances of the U.S. going past that exit are at 25%. How optimistic are you that a plan will be in place, a deal will be in place come June 1st?
You know, I really think we can work something out before June 1st. If you recall, the last time we were in this type of situation, it happened in 2011. We got close, but if you recall what happened, the U.S. credit was downgraded because we waited too long to work something out. But again, I feel confident that we'll work something out. People have to give in on both sides. And I feel confident that at the end of the day, you'll have people on the far right, the people on the far left are not going to be happy. And we got to get both Democrats and Republicans in the middle to be able to get this done and vote and pass it successfully.
Congressman Shauna, thanks so much for being here. You mentioned what we saw back in 2011. You obviously had a front row seat to that. How do the talks, how does the sentiment today compare to what we saw 12 years ago?
You know, it's almost the same type of playbook. And look, with all due respect to my colleagues on the other side of the party, you know, when Trump was there, Trump added, Congress, I'll say Trump, under the Trump administration, about $7.8 trillion in 4 years. And we raised the debt ceiling 3 times, and nobody said anything. And then as soon as there's a president of a different party, then all of a sudden the hibernation cycle changes. People wake up and all of a sudden they talk about debt. So, it's the same type of playbook that we saw in 2011. And it's a way of using leverage to get certain things and certain priorities that our Republican colleagues want. But again, I feel confident that we'll be able to work something out. And again, the far left and the far right might not be happy, but a lot of us in the middle, both Democrats and Republicans, will make sure that we govern at the end of the day.
It certainly feels like the sticking point here comes down to a spending cut versus a spending freeze. Based on discussions that you've had with your Democratic colleagues, a spending cut, is that something that you'd support?
Well, look, I got my own ideas, but I certainly want to give the flexibility to the president and to our leader, Hakeem, to be able to go and negotiate. And again, I'll be willing to work with whatever they can negotiate in a bipartisan way with our Republican colleagues. But keep in mind, I hope we don't go into what we did in 2011, where we had the sequestration, we had automatic cuts, and it was very difficult. I think that flexibility should be left to Congress, where we decide what is given priorities and what is not, should get that level of funding. But I think we ought to leave it to Congress instead of setting certain arbitrary cuts.
Congressman, you said you had ideas. What are they?
Well, again, you start off with low-hanging fruit. Certainly claw back any of the unused monies that have not been used for COVID. There's some non-financial provisions like workfare. Some of those provisions, if somebody's able, single, in my opinion, is they should get to work. Unless if you don't qualify because, you are disabled or some sort of provision. The energy provision, it's something that we've been pushing, and I think that would be good for the economy also. But then it comes down to you go back to the year 2022 level, which means $131 billion cut. and that means that you don't touch anything that deals with defense or veterans or homeland security, and that leaves a big, very difficult spot for other things that are important to us, like education and healthcare. So we got to make sure that if we're going to be looking at working this out, that we put everything on the table and not come in with preset conditions like our Republican friends want to do.
There's an idea being floated out there about potentially delaying non-debt payments so that essentially you can go up to June 15th where you get the tax deadline, you get additional revenue that pushes you to a wider window here to negotiate potentially towards the end of the summer. Is that still a possibility? Is that still something that's being discussed right now?
Well, you know, I prefer we don't go that way. Either we do a short suspension, which I know the speaker has said he doesn't want to do that, but that would be one way to give us a little bit of time, or we reach an agreement. But you know, when they talk about not paying this and doing this, I mean, you know the drill. What we're talking about is erasing or suspending the debt for something that we agreed to do this. And a lot of this, you know, keep in mind what happened, you know, under Trump in 4 years, $7.8 trillion that it got added to the debt. So, you know, the hibernation cycle changed. People woke up from the other party, and all of a sudden debt is very important to them when they should have said something back 4 years during the last prior 4 years. So again, we want to make sure that we work something out, but they got to make sure that, you know, the more difficult part, I think it's going to be a McCarthy, because if he works something out, will the Freedom Caucus pull the trigger on him? And you remember what happened when it took him 15 times to become speaker. They put that where one member can ask that he be called back. So he's got a very difficult situation. And when he made that agreement to become speaker, he left some landmines for situations like this. So he's in a difficult situation. I think he can do it. I really think he can do it. And I want to wish all the parties success so we can work this out. We can do it. We're not going to default. No matter how far left or how far right, people don't want to default, even though some people have ideas about, you know, priority payments and all that. I don't think we need to go into that route one way or the other.
Congressman, one thing we did hear from the speaker earlier today, and we know both sides of the aisle have been pointing fingers at each other, but the speaker blamed President Biden and the Democrats for coming to the table too late for these negotiations. What's your response to that?
My response is that he is right in the sense, but it wasn't the Democrats. I think the fault were the Republicans. Where were the Republicans when they were in hibernation during the Trump administration, when we added $7.8 trillion and the debt got suspended, raised 3 times under the Trump administration? Why is it that people only wake up when there's a Democrat? We saw that in 2011, and we see the same playbook here. So he can put the blame on it, but if he was really interested in the debt, he should have said something under Trump, and he did not. But now he's trying to use leverage, just like the Republicans did in 2011 against a Democratic president. They're doing the same thing with President Biden. So when he says, that it was brought too late, he's right, but not on the Democrats. It's on the Republicans that were, without due respect, were asleep or in hibernation back during the Trump administration when we added $7.8 trillion to the debt.
Well, we are certainly coming down to the wire here. 8 more days until that X date. The Treasury Secretary has highlighted June 1st. Congressman Henry Cuellar, thanks so much for joining us today. I really appreciate the time.
Thank you so much.
Well, Florida Governor Ron DeSantis has filed his paperwork with the Federal Election Commission saying he is running for president in 2024. He joins an already crowded Republican field that includes former President Donald Trump, Senator Tim Scott of South Carolina, and former South Carolina Governor Nikki Haley.
One of the big market movers today is some of those retailers. Two of the top trending tickers on Yahoo Finance, Kohl's and Abercrombie. Kohl's reporting an unexpected profit in the first quarter. Shares are jumping. You're looking at a gain of nearly 29%. It also reaffirmed its full year guidance as it navigates a turnaround. Now Abercrombie and Fitch reporting a surprise profit. They are also raising its guidance for the second quarter full year here. When you take a look at the performance that we're seeing in Abercrombie today, with that stock up 28%, the best day that we've had in just about 4 years. Certainly bucking some of the trend that we have seen in retail, Kiko, when it comes to the cautious consumer. A number of call outs last week when you take a look at some of those big box retailers, Walmart, Target, Home Depot, saying that they are seeing a pullback here in consumer spending. When it comes to some of these smaller shops, smaller retailers, Abercrombie, Urban Outfitters, they're really showing that their consumers are still spending in this environment.
Yeah, it's interesting to highlight these two names because these are two companies that are really in the thick of a brand transformation, a turnaround, however you want to characterize it. You talk about Abercrombie and Fitch. Certainly that is one of those names. And interesting things that to me highlighted where things are for them in the company. You talk about where the consumer is right now. When you look at the strength of their quarter, certainly points to their ability to withstand some of these headwinds with a very hyper focus on who their consumer is. I also thought it was interesting highlighting some of the overhangs. We haven't necessarily talked about more recently, Shauna. I feel like this was the big theme last year, which is the inventory levels, the freight costs, those rates. That has started to clear here, and we saw that with Abercrombie talking about inventory coming down significantly, 20% from where it was a year ago. So they are able to look at that and compete sort of with even some of these economic headwinds. Kohl's sort of in a similar position, but you could argue they've got a heavier hurdle here. Still heavy discounts because of the inventory levels that they were. And you talk about the cautious consumer here. We did hear from CEO Tom Kingsbury, who said specifically the middle income consumer is getting squeezed, and it feels like we have been hearing that over and over throughout these retail earnings calls.
Yeah, certainly it could be a tough couple of months here for Kohl's as Kingsbury does try to really turn around this retailer. Kohl's, we know that it has struggled now for some time. When it comes to inventory levels, that's such an important point to bring up because we were talking about that quarter after quarter following the pandemic when these companies did stock up on their goods because of what happened with supply chains. They're still working through it. Yes, they are making progress with Kohl's inventory. They're falling 6% on a year-over-year basis, but the company is still having to mark down some of that merchandise that it still can't clear from its shelves, given the fact that consumers are pulling back. Declining same-store sales from Kohl's is something to take note of, given the fact that does point to the cautious consumer, the overall trend here in retail. But it looks like investors focusing on the positives when it comes to Kohl's. The shares up just about 6%. We are just getting started here on Yahoo Finance Live. Coming up, Amazon holding its annual shareholder meeting. We will break down the biggest takeaways from the event. And later, our very own Brian Sazi sitting down with Abercrombie & Fitch CEO Fran Horowitz to discuss the company's strong Q1 earnings report, what lies ahead for the retail industry. We'll be right back. Watching the price of oil jumping on the heels of the latest inventory data. Ines Frey is here with the details. Hey, Ines.
Hey, Shauna, that's right. A big drawdown when it came to inventories last week, and that's why part of the reason why we saw oil spike today. You saw crude inventories that came down by more than 12 million barrels. That was a big surprise because analysts had been expecting it to go up by about 800,000 barrels. Also, gasoline was down by 2.1 million barrels. Now, the Memorial Day is really the kickoff. The Memorial Day next week is really the kickoff for the driving season for the summertime. So the thought being perhaps that retailers were stocking up on gasoline ahead of the Memorial Day weekend. Also some commentary from Saudi Arabia's energy minister, basically warning short sellers, watch out, saying watch out, there could be pain ahead. Now, he said commentary before like this, similar to this in the past, but the speculation is, could there be further output cuts in the future when it comes to OPEC plus? Oil today reaching a 3-week high before coming down just a little bit, but nevertheless settling up about 1% below $74 per barrel for WTI. Brent crude up more than 1% when it comes to the price of Brent. I just want to point out a year-to-date chart just briefly. Remember that output cut that we saw in April, when at the beginning of April? That's when you saw oil spike there. It has since come down here. So it's basically at the levels before that output cut was announced back by OPEC plus. Same situation when it comes to WTI. But nonetheless, the impasse in Washington when it comes to the debt ceiling, that has also been putting a lid on oil prices recently, guys.
Yeah, certainly. The conversation has changed because once we did get that oil cut, there was lots of talk about it heading 90, maybe even $100 a barrel. Here we are today, $73 a barrel. Ines, great stuff. Thanks.
Well, high inflation, the threat of a debt default, and volatility on Wall Street, all adding to growing concerns about a potential recession in the U.S. So how do you position your portfolio in this environment? Let's discuss with Brian Jacobson, Annex Wealth Management Chief Economist and Strategist. Brian, good to talk to you today. Let's start by talking about what we heard from one of the Fed officials today, Fed Governor Christopher Waller, saying essentially that he doesn't believe a pause is on the table here until that data shows that there is, in fact, cooling inflation. He sort of suggested we're talking a few months out from that. And yet the FOMC minutes we got today appears to suggest a pause in place here, partly because of debt talks right now, partly because of other economic concerns. What's your base case that you're operating under right now?
Yeah, thank you for that. I think that really what this is highlighting is that there's really a division of opinions on the FOMC. Governor Waller, I respect him deeply, but I do believe that he's actually in the minority with his view that there really shouldn't be a pause. So I would label him as being one of the most hawkish members of the FOMC. According to the minutes, it seems like there is that consensus that we've done a lot already, and maybe it's prudent just to take a little pause here. Doesn't mean that they have to commit to cutting, but they really don't necessarily need to do a lot more. They can just see how things shake out in the near term.
Brian, what about what the market is pricing in terms of what we could see the Fed do by the end of the year, even at the beginning of next year when it comes to potential rate cuts? Do you think the market's still being a bit too optimistic about that?
Yeah, we do. So here at Annex on our investment committee, we kind of discuss what's going on with the FOMC, what they're saying, and then also what is the market pricing in. And it seems to us that the market is getting a little ahead of itself, being too optimistic that the Fed is going to react very quickly to any sign of weakness in the economic data. Historically, the Fed has been very fast in responding to crises, but very slow in responding to recessionary indicators. And so our base case is that the Fed is going to try to stay on hold probably until at least October, if not until the December meeting. So the market might be a little ahead of itself, and as a result, setting itself up for a little disappointment.
Yeah, you talk about a potential hold for the Fed. It sounds like you feel like you should be in a holding pattern, or investors should be in a holding pattern as well because of the uncertainty around policy right now.
Yeah, that is really our positioning right now, is not that we are encouraging people to be out of the market or in the market, because that's kind of a fool's errand to try to time that. And really what we're focused more on is the positioning within the market. And if you think about kind of broadly the types of portfolios that do well in different environments, you can have good time portfolios, you can have tough time portfolios, and bad time portfolios. During tough times, so maybe a short, shallow recession, a little bit more volatility, a tough time portfolio would just be higher quality on the fixed income side, but then also higher quality when it comes to equities. And we're finding a lot of that as far as what we would call the cash cows, those companies that have relatively reasonable valuations, but have really a demonstrated ability to generate free cash flow for investors. The areas that we like most are mostly in the small cap value space and outside of the United States.
Brian, why do you think investors are shrugging off what's happening down in D.C.? Because yes, this Dow fell about 200 points yesterday, off almost 200 points again today. But when you put it in context about what could potentially happen if we do default, they don't seem too concerned.
Yeah, I think it's because politicians tend to be almost like the story Chicken Little, right? Kind of running around, the sky is falling, but it doesn't actually fall. And so we've sort of seen this before. Yes, they want to push it to the last minute, and then ultimately they'll come together. Everybody will declare victory that they ended up winning. Obviously, as we get closer to that deadline, it gets a little bit more stressful to kind of watch that play out. But given the tone out of McCarthy and President Biden, we do think that we're still incredibly high likelihood that they'll come to a deal, probably, let's say, by Sunday, maybe by after the Memorial Day weekend, to end up lifting the debt ceiling. But we would still assign an incredibly low, if not vanishingly small, probability of the U.S. government actually defaulting on its interest and principal payments.
So no need to hedge against a potential default. You think the moves that we have seen in the market are pretty justified, given the reality in D.C.?
We do, yeah. And if you really kind of think about it, some of the moves on the optimism and the pessimism around the debt ceiling, it's really meant, plus or minus 1% on the S&P 500, because the bigger story is really about the roving recession that the economy has been going through. The fact that S&P 500 earnings fell about 26% from the fourth quarter in 2021 to the fourth quarter of 2022. So we've already had a profits recession. The market has responded to that. Now, how much more is left? And I think that's really the bigger question for investors. And that's where we think that positioning within those higher quality names can really be beneficial to help you ride through any type of volatility that we'll experience.
Brian, one of the areas that you are looking at here is international and emerging markets. More specifically, where are you seeing that buying opportunity?
Yeah, so Japan is a good example of something that we were noticing for a while, as far as from a valuation perspective, fundamentals because of the weak currency, also highly levered to the China reopening story. Now it seems like things are getting a little bit better in Japan as well from an economic perspective. And so that area has already run. It probably still has more room to run. But other areas is just kind of broadly with, say, European equities. A lot of people are still worried about what's going to happen now this upcoming winter, since the troubles in Ukraine, between Russia and Ukraine. If that's going to continue, what does that now mean for natural gas storage for the upcoming year, right? It's almost like there's this perpetual belief that they're going to be falling into a recession, but the reality is they've been defying those expectations. So European equities, kind of broadly, it's got more of a value tilt to it, which we actually kind of like here. And it is likely to benefit from a weaker dollar over the long term. We don't think the dollar is going to be collapsing under its own weight here, but a little bit of weakness on the margin would actually likely be beneficial for international as opposed to U.S. investments.
What about emerging markets? I mean, you talk about a weaker currency. Certainly the concern around EMs has been the dollar-denominated debt, but also you talked about the China reopening play. Is there money to be put aside there?
So we like to be a little bit more selective when it comes to EM, right? It's a number of different emerging markets, so it's always a plural and not a singular. And if you actually look at the Chinese market, it almost did a round trip this year. So it had a really good start, and now it's given back all of its 2023 gains because the reopening hasn't been quite as strong and vigorous as what people were originally expecting. And so where we're seeing actually more opportunities when we talk to the individual managers that we allocate to would be areas like, let's say, India. much more favorable demographics. They also have some reforms that are continuing to go through, probably going to weather any type of international volatility on a geopolitical front better than what China might. There's still that tension between the US and China. India might be a beneficiary of that, but you can also look at other countries, even say in South America. Obviously, lots of political issues pop up all the time in emerging markets. It's one of the reasons why they typically trade at a discount to developed markets, but the fundamentals actually seem like they're in a pretty solid place for some areas like, let's say, Brazilian exposure, or even in Mexico.
Brian, bringing it back here to the U.S., certainly what has been driving the market here has been the tech's performance and what we've seen from a number of the larger cap tech companies. Why do you think that momentum, or do you think that momentum is going to fade?
Yeah, we're not really all that optimistic about that momentum continuing. One of the problems with momentum is it can actually reverse rather quickly. That's one of the problems with kind of chasing winners. You do want to let your winners run, but sometimes they can then run into a wall when things actually end up reversing. We think that a lot of the resiliency and strength within tech very concentrated in actually companies that are very good cash flow generating companies. We have to remember that in 2022, that was a rather tough period of time for some of the big tech. So you had a decent rebound. They proved that they have resilient profit margins. That was the formula. People were caught a little bit off sides on that trade. And so you probably saw a little bit of overshooting in terms of how those stocks have done. That's the reason why we're actually more biased towards, if you kind of have to think about it most simplistically, instead of thinking about a market cap weighted portfolio for your exposure, think about maybe more of an equally weighted exposure, right? There's all sorts of ETFs and mutual funds that you can get exposure using that type of strategy.
Yeah, it feels like that's increasingly a theme that we are hearing over and over. Brian Jacobson with Annex Wealth Management. Good to talk to you today. Appreciate the time.
Amazon holding its annual shareholder meeting today with CEO Andy Jassy at the helm. Yahoo Finance's Ali Garfinkel has been listening in. Ali, what are your main takeaways from this meeting?
So first things first, Shauna, the rah-rah Amazon era is over. I would call the vibe on this one of sort of attempted positivity. And you'll sort of see this as I run through these top three takeaways. So number one, cost cutting. This is a story we've been hearing in tech over and over again. And I'm on the record saying that I haven't found Amazon's cost cutting story to be particularly convincing narratively. And though some of that continued today, it is important to say that CFO Brian Olsavsky, if you're sitting out there watching this, was talking specifically about cost cutting in AWS, particularly tapping customers to help in that cost cutting process as well. Retail also got a shout out in cost cutting. But for anyone who hasn't been following this, the crux of it is Amazon's retail business really blew up in the pandemic, and now they're trying to sort of shrink it down a little bit to something more efficient. So those were sort of the two key areas they talked about. But again, I still don't find this to be as compelling a narrative as some of the others we've seen on the street. Now, let's go to number two, AI and healthcare. For CEO Andy Jassy, that's what he really was talking about in terms of Amazon's future. For AI, he sort of reiterated the company's B2B approach that we've talked about. He mentioned Bedrock, Amazon's generative AI application, and it really was the story we've heard before. And in terms of healthcare, what was really interesting is he positioned Amazon's One Medical deal, which it did last year, as sort of the successor to Amazon Care, which the company shut down earlier this year. In both cases, for both AI and healthcare, Jassy talked about both as being incredibly long-term investments and it being where he sees the company truly adding value down the line. And the last thing, I know I'm being a little bit flip about this, but everybody hates Amazon. There were a record 18 shareholder proposals at this meeting. As a frame of reference, guys, 2 in 2018. So that is a massive spike. And a lot of these shareholder proposals really focus on worker health and safety. It's something we've heard about Amazon before, and it's something that we will continue to hear again and again. And to be totally honest, listening to, I don't know who's out there has listened to an annual meeting recently, but they can be quite long, and especially when there were a lot of shareholder proposals, it was really one after the other of people who work at Amazon talking about the ways in which they don't feel like it is a good place to work. It was in a lot of ways, to me at least, an astonishing airing of grievances.
Yeah, I mean, a record number of shareholder resolutions here when we talk about 18. There's also going to be an employee walkout in Seattle a week from this meeting. What do we know about that?
Yeah, Kiko, we have just started to really get some information here. It's important to say this walkout is happening in the backdrop of layoffs that Amazon has been doing, cutting 27,000 people over the last few months. So far, this walkout, what we know is this. It's scheduled for May 31st. Lunchtime. It is focused on the corporate workforce, and it is it's been being organized between two groups. One is an internal climate advocacy group, and the other is a remote worker advocacy group. I'm careful about these things because any worker actions can always be really fragile, and you don't necessarily even know what's going to happen till the day of sometimes. But I do think this really bespeaks the current state and low morale, frankly, at Amazon.
Yeah, certainly, and also really speaks to the heightened tensions that you can say between maybe management and also a number of their employees. Ali Garfinkel, thanks. Summer just around the corner. More employees are looking to work remote. Up next, we will tell you which REITs are being hit most by the sluggish return to office rate. Don't go anywhere. EV shares under pressure today, driven lower by Chinese company XPeng. Yahoo Finance contributor Remy Blair is on the floor at the New York Stock Exchange with the details. Remy.
Well, as you mentioned, we're seeing shares of XPeng lower in New York afternoon trade, but shares are well off session weakness. Earlier in the session at the open, we saw shares of XPeng tumble by as much as 16%. And this does come as the EV maker based in China reported earnings that missed expectations. First quarter sales were off by a whopping 46% year over year, with the company losing precious pennies for each vehicle that it sold. Also, losses were increased by 38% year over year for the company's bottom line. Now, its demand outlook also weighed on shares of the automaker, projecting a year-over-year decline in second quarter deliveries as well as revenues. The company says that second quarter deliveries could fall by as much as 39% year on year. And as you mentioned, we did see shares of other EV makers tumble today, but some have been reversing earlier weakness. Tesla shares are lower, snapping a recent winning streak of 5 days, while Shanghai China-based NIO fell to 3-week lows. Earlier in this session, we saw Beijing-based Li Auto open lower, but now they have turned slightly higher in New York afternoon trade. While for XPeng, we are expected to see deliveries of its G6 SUV at the end of this quarter, and its models are expected to come off the production line this week. Now, only time will tell whether sales of the new SUV affect XPeng in the second half of this year.
All right, Remy Blair, thanks so much.
Well, the post-pandemic real estate reality is taking a toll on the office sector, with employees opting for remote or hybrid work instead of a return to the office full-time. The share of people in office full-time dropped to 42% in the second quarter of 2023, according to the Flex report. The sluggish return to in-person work is hitting share prices for some of the largest office landlords, dragging down market sentiment on the future of office stocks. Here with more on the pulse in real estate, we have BMO Capital Markets Managing Director John Kim. John, is there any indication that there's going to be a turnaround?
I think the quick answer is no. We're riding a perfect storm right now in office when you have a secular question mark whether or not people are going to come back to work, how many people are going to come back. You have a cyclical downturn. Companies are downsizing. We just heard Ali talk about Amazon downsizing and cutting costs. And then you have the financing environment where interest rates have risen dramatically over the last 12 months, and that makes it much more difficult for office owners to refinance debt that's due over the next couple of years.
So John, is the worst still ahead then, it sounds like, maybe for office space?
I think the worst is ahead. I mean, we have a couple of years where it's going to be very, very challenging. And we need the economy to really pick up. We need employers to start hiring, rehiring, expanding their workforce, and then there needs to be a real adoption on return to the office, because right now it's hovering around 50%. There's not many cities that are above 50% office utilization. Having said that, the office REITs are trading at historically low multiples. We're looking at GFC type multiples for a lot of the office REITs. Yesterday, Empire State was up 11% on releasing a space that Signature gave up, and the bank that took over Signature decided to take the space, and the stock went up 11%. So that just shows you how bad sentiment is for office right now. And any inkling of good news will provide at least a short-term boost for the stocks.
Yeah, John, I thought it was interesting. You said the sentiment is so bad you expect cab drivers to start saying that they're shorting any of these names as well. Is there a play to be had here, though, given just how far these names have fallen?
I think there is if you're looking as a value investor over the next 2 to 3 years. But if you're looking over the next 6 to 12 months, most of us tend to be short-term investors. The headwinds and the headlines are just going to be so significant. So I would say avoid for now. But if you're looking over the next 2 to 3 years and saying, look, we've never seen multiples this low. When you look at the multiples back at the GFC, they did rebound when the economy improved. That's when you could see or make a case that office could get better. But a lot of stars have to align for this to happen.
John, are you seeing any trends by sector in terms of who is re-signing their leases, or on the flip side, who is letting their leases expire and then either downsize or just not lease office space at all?
Right now, it's financial services firms that are very active in the market. That's why we tend to like New York better as a market than we do the West Coast office REITs. Small businesses are very active. A lot of small leases are getting done. But when you look at the leading companies in New York, whether it's Blackstone, Goldman Sachs, the hedge funds, now BlackRock, they're all returning to the office and mandating it for their employees. And that's a big difference between a lot of the financial services firms and the tech firms that are very, very reluctant to bring their employees back.
What about flexible workspace? I mean, you know, certainly you can expect, especially these tech companies, if their lease is up, they're not necessarily going for long-term leases anymore, and yet there seems to be at least a desire on the part of the companies for some form of in-office work.
I think that's, at the end of the day, most people and most managers want their employees to be back in. And I would say most employees don't mind being back in the office. What they don't want to give up is flexibility, and what they don't want to have is a daily commute that could be pretty long. So I think the flexibility is the key term, whether it's flexible leases. Maybe some office owners provide more flexibility on the lease terms. We haven't seen that really quite yet. Or flexibility as far as what employers offer to their employees, just to keep them happy and make sure that they have enough independence on their free time.
So John, office under a tremendous amount of pressure. What about some of the other areas, though, of commercial real estate? When we take a look at industrial, multifamily, retail, where are we seeing the most strength there?
So we like industrial the most out of the ones you mentioned, actually out of all the sectors within real estate, because there's a lot of embedded growth in the leases. We're talking about, in some cases, 50 to 60% embedded rent growth in the leases when you just market to market. So even if market rents start to come down, which we're not seeing this year, there's 50% growth in a lot of the industrial REITs. Multifamily is a sector that we tend to like, but we don't know what's going to happen over the next 12 to 18 months. So if the unemployment rate goes from 3.4%, hovering towards 5%, then the growth of rents is going to decline pretty significantly. So we're a little bit more uneasy on multifamily than we are with industrial and some of the other short-term asset classes.
A lot of uncertainty there. BMO Capital Markets Managing Director John Kim, good to talk to you today.
Thank you.
Well, coming up, TikTok's troubles continue. Documents obtained by the New York Times regarding a messaging platform used by TikTok employees is raising eyebrows. We got the details for you on the other side. Microsoft is out today with details on cyber attacks detected from a Chinese-based threat targeting U.S. and Guam critical infrastructure. Here with more on the details, we've got Yahoo Finance's Dan Halley. Dan, what are we learning?
That's right, Kiko. This is a, as you said, Chinese-based threat actor. Essentially, what they were doing was targeting a slew of different types of organizations and different types of facilities, whether that's communications, manufacturing, utility, transportation, construction, maritime, government. It's basically a type of attack that is difficult to detect. It goes through small offices and network equipment to help avoid detection. And Microsoft, again, saying that this is a China-based threat actor, though not specifically the Chinese government. Just because it's based in a country doesn't mean it's from that country. Microsoft calling this Volt Typhoon and saying that their Microsoft vendor antivirus helps to detect things along these lines, and that's where they're getting this information from. But yeah, this is one of the stories that you're going to continue to hear. Obviously, some different groups are going to be continuing to attack different types of infrastructure, and this is a clear case of that.
There's another tech company in focus today on concerns around security. Documents obtained by the New York Times pointing to what exactly is being shared in this internal messaging app that's being used by TikTok employees. That's raising a lot of eyebrows here. What have we learned there?
Yeah, this is called LARC, and essentially, if you use Slack, if you use Google Chat or something along those lines in your organization. It's an equivalent to that ByteDance produces. Now, they have employees talking on this in the US and in China. And the fear here is that some of the information the New York Times uncovered is personal information, driver's licenses, in some instances, some illegal content, and it's put into these chat rooms where people can see it. Now, just to give you an idea of what LARC is, TikTok CEO is actually on Capitol Hill discussing it, and we have a clip of that.
Does every TikTok employee have a LARC account?
Yes, I believe so.
And as you mentioned, it was developed by ByteDance, so it's not just used by TikTok employees, it's also used by ByteDance employees, is that right?
Also by other companies now. I think LARC is selling it, and it's a good tool for instant messaging.
So LARC is available to third parties outside of the ByteDance system as well, like
yes.
Slack?
So that's, essentially a rundown of what exactly LARC is. Again, it's kind of a Slack equivalent, but the problem is that we've been discussing, the fear is that American content or American user content can be viewed by Chinese officials because of that tie-up where China can basically request a company's information and the company has to turn it over. And so TikTok has said, look, that's not the case. The Chinese government hasn't requested American user data. But this is an instance where workers in China have been able to get access to that data when this information is shared. And so there's that kind of fear. Again, no information that it's actually going to China at all, though.
Yeah, and based on the New York Times story, it certainly feels like it was a little easy to be able to just kind of post that on LARC, but a story that we will continue to watch. Dan Halley, thanks so much for that.
The uncertainty over the debt ceiling taking a toll on the bond market. Short-term yields hitting a 20-year high as we get closer to the so-called X date of June 1st. Joining us now is Steve Laipoli. He's a BlackRock Global co-head of bond ETFs for this week's ETF report brought to you by Invesco QQQ. Steve, when it comes to the debt ceiling, how investors have been reacting to it, what it means for the bond market going forward, what do you expect in terms of the volatility that we could see take place over the next several trading days?
Well, I think you just said the key point. It's going to be volatility. So far, we've seen investors being somewhat circumspect about it. We've seen some rotations out of the short end of the yield curve towards longer durations. I wouldn't characterize that as large size yet, but we are starting to see investors becoming increasingly aware and concerned about this.
Steve, what do you think it's going to take to create those jitters? We have heard that lawmakers aren't likely to act unless they see huge moves in the market. Yes, we've seen some moves to the downside, but not significantly. The fixed income market certainly very much in focus because of what's playing out in D.C. But what do you think could be potential triggers that move things to the downside?
Well, if we go back to 2011, I believe that the situation was resolved about 2 days before the purported X date back then. Leading up to that point, I think you did see a fair amount of equity market volatility. So, will that happen again? We're not sure. We are seeing the market sell off. We haven't seen, any huge drawdowns yet, but, that obviously that type of volatility is going to get increasing attention should it actually transpire. At this point, we think investors should be defensive in their positioning as we're going into this. We also, by the way, have another Fed meeting coming up. So there's a lot going on in the bond market to focus on. We are seeing investors position for that somewhat accordingly. High quality fixed income, longer duration, really trying to put some ballast into the portfolio heading into June, because we do have some market events coming up that could be fairly significant in terms of volatility.
Steve, you've said you've called it a generational opportunity. More specifically, why do you see that, and where within fixed income are you seeing the most opportunity?
Yeah, we did just put out a piece called The Great Yield Reset about the generational opportunity. And why are we calling that? Well, you have not seen yields at these levels since the end of the financial crisis. So, we're going on well over 10 years of very low yields. In the past year, we've had this reset in yields to a level where investors can now earn more at the front end of the Treasury curve in something like 2-year Treasuries than they could in high yield 2 years ago. What does that mean for investors and for portfolios? It means that you can actually hit yield targets now with a lot less risk than you used to have. And so we believe that it is the time now to re-examine your entire portfolio, understand that you can achieve these yield targets in ways that you couldn't a couple years ago, with more liquidity, less credit risk, et cetera. So it's a great time to look at fixed income. At the moment, because of the uncertainty around the economy and all these events coming up, we do recommend investors stick to high quality in fixed income. So we're seeing flows into treasuries, investment grade credit as an example, and then broad multi-sector investment grade funds as well.
Yeah, on that front, Steve, you've said that you think the average portfolio is under allocated to fixed income. Looking at specifically where the money should be in fixed income, what do you think that exposure should look like?
Yeah, I think, as we point out, it's time to re-examine the 40% of your 60-40. And again, it's an opportunity to really think about how that 40 is positioned. So, oftentimes investors in the past would focus on the equity side and simply, say, well, I'll just, throw my 40 into, a broad exposure. It's a good opportunity to actually look at that more closely. And depending on your goals for fixed income, you have the ability now with this ETF toolkit to tailor that in ways that you couldn't even 5 years ago. And so what do I mean by that? So as an example, if you do want more income, you don't simply have to just buy a high yield fund. You can get a lot of income now in safer assets at the front end of the yield curve that 2 years ago you probably would have had to have gone down in credit and take on some more illiquidity to do that. But now you can do that with much higher quality assets. So, also I think it's underappreciated at this point, but the idea that fixed income can provide ballast in the portfolio, and by that I mean diversifying against equities, we believe that is back. And so even adding some duration at this point, once we get through this difficult June period, might make sense. If you do believe that we're heading into a slowdown, it might make sense to start adding back some duration in the portfolio as an offset, to your riskier assets such as equities.
Steve Leopoli, BlackRock Global co-head of bond ETFs. Thanks so much. Well, the Justice Department reportedly looking into trades of former First Republic employees. Yahoo Finance anchor Julie Hyman is here with the details. Julie, my twin, we'll talk about our just a choice in just a second here, but what are we learning on this breaking news?
Yeah, got to get to business first. Indeed, Bloomberg is reporting that the Justice Department is looking into this and whether anyone at First Republic used inside information when making transactions. Now, the company's transactions, executive transactions, had already been under scrutiny by Congress because there were some allegations that some inside the firm had traded on that information going into a worsening situation and then the collapse of the bank. On top of that, of course, there's also a lot of scrutiny into executive pay, both at that bank and at Silicon Valley Bank and some of the other failed banks. So all of this kind of just once again highlighting how much scrutiny there is of this situation here. And we don't know if there are going to be charges in this particular case. The Bloomberg story points out, but we do know that this investigation is going on. Before First Republic was seized by regulators and ultimately part of it sold off to JP Morgan, we did see a big plunge in the shares. So if one was working at the bank and knew on and what was going to happen, theoretically, illegally, one could have tried to benefit from that information.
It's certainly a story we're going to continue to follow. And Julie, you're also taking a look at some of the broader trends that we have seen when it comes to trading in regional bank stocks. They're starting to look a little bit like meme stocks, aren't they?
Yeah, this is a phenomenon that the Wall Street Journal pointed out today that I thought was a good observation. They went into a lot of chat rooms, talked to a lot of retail investors who were looking at the bank stocks anew in this way. If you look at just an example, PacWest, and even how it is trading in today's session, the stock had been coming back recently, and even, as you can see from the daily chart, have been higher at some points over the course of the day. And that's after the company agreed to sell Civic Financial Services, that's one of its unit, to a real estate lending firm as part of its efforts to offload some of its assets and dig itself out of a bit of a financial hole. So the shares initially were higher. Now they've traded lower. If you look at the year-to-date chart of both it and something like a Western Alliance, you can see the enormous swings that we have seen in the stock, most of it to the downside. But there are some things that are sort of reminiscent of the peak of the meme stock craze. Many of these stocks have really come into the public eye, have now become more sort of well-known consumer names, if you will, because of all of this going on. There has been a lot of talk about them. And if you look at the regional bank ETF for the year to date, it's not limited to just a PacWest and something like Western Alliance. It's happened with a lot of the smaller regional banks in the wake of the SVB, Signature Bank, et cetera, collapses. One of the other things that's characterized these moves that at times don't seem pegged to any particular news, right? Except for perhaps an uptick in chatter on a place like Reddit. That's one of the things that we really saw characterize the meme stock craze, is that there wouldn't necessarily be any news, but all of a sudden there would be this uptick in discussion. And the Journal pulled some data from Hootsuite and looked at social media mentions for these stocks. And you can see here the spikes in those mentions of some of these companies that we've been talking about. This is one of the key differences that we've discussed before between this admittedly smaller banking crisis and the great financial crisis, is that social media wasn't really a factor at that point in time. In addition to that, you didn't have commission-free trading. You didn't have something like Robinhood. So it wasn't as easy both to communicate about these kinds of names and then also to trade on them. And then finally, one more thing that has sort of characterized some of the meme stock trades in the past is short squeezes, right? High short interest and then short squeezes. And S3 Partners has tracked some of these surges in short interest related to some of these banks. And you have definitely seen that. In fact, it's gotten to such a point, of course, is that some of the banks themselves and some regulators have called for at least temporary bans on shorting activity in some of these banks. That hasn't really gone anywhere, Shauna, but we've definitely seen that short interest persist, even as we get some squeezes and covering happening at certain times.
Yeah, certainly important trends there to follow. Julie, I got to say, you and I have been loyal Rent the Runway users for quite some time now. This is the first time we've shown up to work in the same exact dress.
It was only a matter of time. Hey, we have good taste.
We have great taste. I know, we got to coordinate for tomorrow. We got to leave it there because we are kind of counting down to the closing bell. We'll be right back. That rounds out today's trading day. Again, losses across the board as the street focuses on the negotiations, the lack of progress when it comes to a debt ceiling deal. You're looking at the Dow closing off 255 points, S&P off about 0.7%, the Nasdaq closing off 73.
Well, retail in focus yet again. So let's do a quick check of shares of Kohl's. That stock seeing a big pop today, up about 7.5% after the retailer grew its profit and managed to reduce its excess inventory in the first quarter. Shauna, we were talking about this earlier about what this means for the consumer. We sort of try to glean information from any number of these retailers. In the case of Kohl's, it does point to sort of that value play. We keep hearing over and over consumers looking for some value, especially as they get squeezed. The inventory thing we're talking about, yes, that led to an average ticket decline because they did have heavy discounts. But the company also said they saw increased foot traffic and customers were buying more items. So that suggests that in a good value, even in this environment, customers are looking to buy here, but it's got to be at the right price point, and that's kind of where Kohl's is looking for.
Kohl's does have the advantage when it comes to that price point, given the fact that they are viewed as a value play. But I think the big question going forward is how much consumers are going to be spending on discretionary purchases. And that's something that Kohl's really relies on when it comes to retail, not necessarily some of those necessity purchases that we have seen at some of the other larger retailers like Walmart, which is also a value play, but better positioned given the reliance or given the fact that their grocery division makes up such a large part of their revenue. But Kohl's saying that they are positioned okay among those value play department store names here. Over the last year, this company has been under a tremendous amount of pressure with shares off just about 40%. So the new CEO there, Tom Kingsbury, certainly making some progress since he took over in February, but a ways to go in order to get shareholders back on board. Another play that we're looking at here, Abercrombie shares surging today, closing up just over 30% after the fashion retailer posted stronger than expected first quarter profit, boosted its annual outlook here. When you take a look at some of the comments here on the earnings call from the CEO saying that the company has raised prices by double digits since the pandemic. They've done that for both of their brands, so both Abercrombie and Hollister there at Kiko. And she said that it's obviously a good move here from the retailer because consumers have shown that they're willing to pay those higher prices.
Yeah, the Abercrombie store is in a better position than their Hollister stores. They did talk about some of the challenges, especially with the teen consumer, but you're certainly right about where they are positioned right now. You know, we were having this conversation this morning, Shauna, about where Abercrombie is right now and how they've been able to transform their brand, change the image from where we remember it to be more than 10 years ago, and then bring these consumers on board even in a time of inflation. So that certainly points to the strength of the brand and the strategy for the company. Inventory, another thing we were talking about earlier today, it's pulling back significantly from where it was last year. And I thought you brought up a good point here. It is fascinating to think, you know, a year ago we were talking about the inventory and just the pileup that we were seeing, especially in freight. It took that long to clear some of this inventory. We're still seeing discounts that are being had there. But in the case of Abercrombie, they have seen a significant improvement on that front. Let's move on here to Intuit shares falling today after its tax season. Revenue fell short of estimates on fewer than anticipated filings. In the company's earnings call, CEO Guzzari said it's possible the government-run tax filing system will cost taxpayers billions, and you see the stock getting hit about 7.5% there. The big question for me, Shauna, when you think about a company like Intuit, what it means if the government does move forward with their e-filing, because that's where they get a bulk of their revenue, things like TurboTax. There's a lot of questions there about what it means for the company moving forward.
Yeah, certainly it could be a massive challenge here for Intuit, given the fact that they're already looking at lower volumes. For their most recent quarter, they reported lower volumes than the street was expecting. So another challenge here going forward, or another potential headwind, obviously, something that shareholders are taking a little bit of issue with. One thing, though, that Intuit did use to its advantage when speaking about some of those lower volumes, they were able to balance that risk here with better pricing. So that's something that was able to cushion some of the blow that the company did see over its most recent earnings report. But again, that trend here is a little bit concerning. One other highlight that I want to point out, though, when it comes to that better pricing, also small business and self-employed segment, that was coming in better than expected, better than what the street was forecasting. 24% growth here in terms of that outlook, up from 19 to 20%. So incrementally better there. But again, I think the big question is down the line, what exactly that e-filing here for the government, what that would do to Intuit's business.
Let's bring in another voice into the conversation here as we broaden out the discussion into the markets. Thomas Martin, Senior Portfolio Manager at Global Investments. Good to talk to you today. Feels like we're still talking about sort of the key headwinds here, the debt ceiling talks, potential pause in Fed policy, and then, of course, concerns about where inflation still is. How are you positioning yourself right now, and how defensive does that portfolio look?
Yeah, thanks for having me on your program. And the way we're positioned at Globalt is what we would say cautiously. If you look at where the market has been trading over the last several weeks since the end of March, we've been in a very tight trading range. I think that's not news to anyone. And we're just all, the market seems to be waiting for something. And some of that is the debt ceiling, and some of that is the Fed. Some of it has been the earnings season that we've been through. But although it's been sort of muted volatility at this point, once that logjam breaks and we start getting new information on the macro front, we may be in for a bit more volatility.
Thomas, when you talk about a bit more volatility, what does that more specifically look like then?
Well, what you have is waiting for the debt ceiling to be done and see what that looks like. It's probably not going to look much like a surprise to anybody other than the fact that we actually have some sort of an agreement. But then the hard work will have to begin as to raising the money to pay for the government. So to begin to sell treasuries. And that's going to have an effect on the liquidity of the market and will make movements in other sectors a bit more pronounced. Especially, you're going to have the Federal Reserve's going to have to be careful in what they do with rates to make sure that they are still sending out the message of dealing with inflation in a very hawkish way, but also being able to have the markets have enough kind of lubrication to be able to do what they want. So the second half of the year could see a movement out of this range.
Let's talk about what we've heard out of some of these earnings reports. Retailers back in focus again today. We were talking about the improved picture on inventory but also looking at the consumer turning a little more cautious. What are some names that you're liking? Do you go to a highly specialized name more like an Abercrombie, or do you kind of stick to the diversified names like these big box retailers?
Yeah, we've been sticking with actually a little bit of both, but we've had Dick's Sporting Goods for one. They had a decent report, and they continue to really evolve their business and to be attractive to consumers. We have Nike in the apparel area, and they've been doing well also. As far as some of these other broader names, we have been cautious on those, whether it's Target or Walmart or Kohl's or whatnot, as we try and see them deal with their inventories. And the reports today were good. It looks as though these things are starting to come in and starting to settle out.
Thomas, another area, another sector that you're closely watching is what's playing out in housing. We got the new housing starts yesterday, better than expected. We certainly have seen home builder sentiment improve. Is that a trend that you think is going to stick?
Well, the big issue in the home builders is that there just isn't a lot of inventory out there. And so that's not particularly good for buyers because it's holding pricing up. But it is good for the home builders who are really the source of new inventory. So if you have existing homeowners who are reluctant to make a move because they may have to get a refinancing at a higher mortgage rate, they're going to be putting that off. But as you add new supply, that's where you have people being able to make a move. So the home builders are well positioned, and that trend is going to continue as long as rates stay high until customers get used to the higher rate environment and what they'll be able to buy with the new level of affordability, especially if prices don't come down much.
What about some of the growth names, Thomas? We were talking about the run up in the tech stocks that we have seen. Is that a place that you'd put your money behind right now, or is there a little caution just given the pullback we're seeing on the macro side of things?
Well, there has to be some caution because in those names, the FANG names in particular, Microsoft and Apple and NVIDIA, et cetera, those are names that mutual funds and many investors have been underweight. And part of the reason they're underweight those names is that they just are large proportions of the S&P 500. Certainly Microsoft and Apple have outsized positions in those indices, and it's if you want to own something else, then that has to come out of somewhere. So those names have gotten very bid up, and the hype with AI and with all of the things that they can do is very attractive to investors. But at some point, they have to take a breather. And so it's not particularly concerning to me that those names start to slow down a little bit. They have to wait, but the underlying fundamental trends are very good. So you want to own them, but you want to be careful that, be ready for it, at least somewhat of a correction in the interim term.
Thomas Martin, Senior Portfolio Manager at Global Investments. Good to talk to you today. Well, coming up, we are recapping some of today's top stories and trending tickers. Stay tuned.
Stocks ending the trading day lower. You're looking at the Dow closing off 255 points. Let's take a look at some of the top trending stories of the day. There are a record number of women working, a big reversal than what we've been talking about after the pandemic triggered an exodus from the workforce. Now the participation rate of women aged 25 to 54 in the workforce, that climbed to nearly 78% in April. That's according to the Bureau of Labor Statistics. We have Alexandra Canal, Josh Schaefer, Press Supermanian here to break down all of these top trending stories. Ali, let me kick it over to you, because when we talk about females in the workplace, a lot of the loss that we did see during the pandemic was because a lot of women had to leave in order to care for children, in order for elderly care. They weren't able to work and really go, or I guess, allocate as much time as they needed to. I think that flexible work component that we're seeing now is somehow playing into this.
100%. I think the fact that we've moved into a more hybrid work environment, even in some cases a fully remote work environment, is critical for a lot of those women who initially left the workforce. I also think the fact that we have unemployment so low, a lot of job openings right now, higher wages, that's more of an opportunity for women to get back in there. Also another factor, just basic necessity, right? Inflation is really high. The cost of rent, food, childcare is high, that you can no longer really require just one income in order to pay for all of that. So I think there's a multitude of reasons, but it is interesting to see this trend, considering how many women did initially leave the workforce at the peak of COVID.
Yeah, the drop-off's pretty huge, right? When you take a look at that chart that we were just showing of how many women weren't able to work. But I do think the biggest thing does have to be the fact that, like you said, Ali, costs are higher now, right? Costs are higher, people need more incomes, and the ability to basically work maybe not even full-time or work a full-time job, but at weird hours, I think is advantageous for a lot of families too. You can work 8 hours, but it doesn't have to necessarily be 9 to 5, right? You can go and do pickup or split with your partner and do things like that and be able to manage it. And I think that that's something that has totally changed and probably will continue to benefit this moving forward.
Yeah, I think that when you compare pre-pandemic to post-pandemic, is it really just a hybrid work situation, right? That's at the biggest factor at play for that huge percentage of 77.5% people now in the workforce. Also, you guys tell me about this, but women are going to college more, getting higher degrees. The study mentioned lower fertility rates, people having children later or not at all. That would boost it, I imagine, right?
Yeah, certainly that does boost it. That certainly is a factor here that's in play. When it also talks about childcare, now I think a lot of women have returned to the workforce clearly by the numbers, but it is still an issue when you talk about the lack of childcare, daycare centers not having the staff. People aren't able to get their children into the daycare centers because of that. I think that is still keeping some women from the workforce, but still the fact that we are making progress, the fact that we are seeing participation at a record high, clearly moving in the right direction.
It's a good sign for now, right?
It is.
It's good. Things are headed in the right direction. But let's take a look at retail. I want to take a look at Abercrombie & Fitch and Urban Outfitters, both reporting better than expected earnings today. So Abercrombie's same-store sales up 3% this quarter compared to an estimated loss of 1%. The retailer also raising its guidance. Now Urban Outfitters, for its sake, total net sales for the quarter increasing nearly 6%. Shares of both those retailers are trending up on the news. And guys, this is, as we've seen, sort of questionable commentary and earnings from other consumer-facing brands, right, and other retailers. When you take a look at what we heard from Walmart, they were sort of warning of a trade down. Target warning that there's been discretionary spend or declining discretionary spend. And even when you look more in that clothing area and you take a look at Foot Locker and what happened there and Under Armour, really kind of a different story from Urban Outfitters and Abercrombie. I don't know if it's just more people are going back to Abercrombie and Urban Outfitters. I'll defer to other people.
Ali's one of those people.
I'll defer to other people at the desk as far as where it's
earnings.
popular to shop, but it seems like that probably is part of the story.
Yeah, and to me, I'm a newfound fan of Abercrombie. I used to be when I was way young, then I fell off of it, but recently they have great bodysuits, they have great pants, and they have great workout outfits for those that are looking for that. But I also think this is a story that speaks to the higher end consumer. We were just talking about people buying Chanel and Birkin bags. Certainly, they're going to be spending $40, $50 for a nice pair of high-waisted jeans. So I think that is something that is going to continue, and we're going to continue to see that. That being said, though, UBS did have a note warning that there could be further downward pressure for some of these names, in particular Urban, especially in the back half of the year amid inflation, that is eventually going to catch up to consumers. However, I'm not totally convinced of that argument since we have seen inflation moderating. But again, we'll have to wait and see.
To me, the Abercrombie turnaround story has just been fascinating because it was very popular with my generation. I'm a millennial. So many people shop there, 6th, 7th, 8th grade, even the beginning of high school. And then you never heard about it. At least I didn't hear about it for years. Now that same group, millennials, are the ones that are back in the stores. And it's just been amazing how they have been able to totally rebrand, get people who boycotted the store so that they would never shop at Abercrombie back into their store. And I think this really tells us a lot just about that nostalgia play, what we have seen work in the past. And Abercrombie is doing a very good job at really capitalizing on that. Not only that, but also just keeping that momentum going.
I mean, Abercrombie used to be a disaster from a reputational point of view with all the sort of the controversies there. The Mike Nichols, what was his name? Mike, I can't remember the old
former
CEO.
Yeah. I did watch a Netflix documentary.
Yeah, right. So they've sort of, like you said, the nostalgia's back. I mean, I remember being kind of a little nervous walking in there. It was like you smell the cologne and it's all dark and stuff.
Experience.
But it was like you said, it's a nostalgia play. But it's also like the teen kind of spending patterns, right? We talk about Urban Outfitters too, right? A lot of strength there. Abercrombie back. I believe it's teenagers and younger people who are shopping there, and I think that's showing that the resilience there, that people want to spend. Maybe they don't have to spend on food and shelter because maybe they're living at home or they're in college. So maybe it helps that that consumer can spend still right now without a concern about the recession, the economy, things like that. I can keep buying my t-shirt.
It's an interesting point, right, Pras, when you think about different consumers that we're talking about. Someone that's shopping at Target and Walmart is probably also paying for insurance and paying for a new car and paying for groceries and paying for things like that. Someone that's buying a t-shirt at Urban Outfitters might just be a 17-year-old that wants a cool outfit and wants a $20 shirt. And I think that's different when you think about wallet share and sort of where people are spending and how that translates to what we're seeing in the businesses. But it was interesting in that note that you were talking about, Allie, when you take a look at where apparel is. Apparel right now is the one thing that consumers are opting out of the most. It is the most active thing that people are saying, you know what, I'll delay my apparel purchase. And so I think moving forward, you wonder when does that start to show in these results?
Yeah, you would think soon.
And one quick thing to note about Abercrombie is that if you go on their website, they actually give you recommendations for what to pair with certain pieces so that you can have a full outfit.
We're still promoting Abercrombie. We're all back to why we shop there.
Exactly. And look, you might need new clothes. Maybe you're traveling this summer because a lot of Americans are. A booming travel season is already upon us. If you take a look at heading into Memorial Day weekend, TSA is screening over 2 million passengers a day. That's on par with pre-pandemic levels. And summer is expected to be busy. Travelers are likely to encounter long security lines and high prices. Airfare to Europe and Asia, they're already seeing their highest levels in more than 5 years, according to Hopper, which really pains my soul since I want to go to Europe at some point. Hopper's saying that the most desired destinations are Paris, London, Rome, the 3 places I want to go. But it's just interesting to see this travel boom, which we've been seeing across the board. At the same time, though, we have major airlines like United and JetBlue also trimming back the amount of flights that they're offering due to some of those pilot shortages, air traffic control shortages. So overall, an interesting time.
You know, it's funny you mentioned people are spending less on clothing and things like that. They're spending on experiences. They want to, post-pandemic, I want to go somewhere. I want to spend time with my family. I want to see new things. I want to experience it. I don't need a new T-shirt or a suit or matching outfits or whatever you said before. But yeah, I think that's a big part of it. Like you said, airfare, 5-year highs for Asia and the EU. I mean, at this point, it's like who do you bet on for your investors, right? Airlines. Hotel chains. I mean, what do we do here? Is it the Expedias, the Booking holdings of the world? Are those the plays right now in this sort of world where people don't necessarily want to buy material things? They want to go out and do stuff. So car rental companies. I mean, there's a whole number of recreational plays out there for investors.
And those names have been outperforming as we talk about more and more people wanting to travel. And we had it up on the screen. If we can put it back up there, just how much people are spending to go on these international trips. When you take a look at Europe, the average price there, $1,100. Comparing that to what it was not that long ago, $850 last year, $861 in 2019. That's a heck of a lot of more money. And then when you take into account some of the other places, people going $1,800. This is in an environment when people are worried supposedly about a recession, looming fears just about what exactly that economic slowdown could potentially look like. Sky high inflation, yet people are still dishing out a heck of a lot of bucks on travel.
It gets back to the high-end consumer is clearly still spending here, right? Yeah. Someone is spending money. because people are buying those flights and they would be cheaper if no one was buying them. That's how simple supply and demand works, right? But I do think another part of this, how do we get more air traffic controllers, guys? We need to get more people there so they stop cutting these flights from New York and things can flow a little bit easier. You have more options. I've found just looking online, there are certainly fewer options for flights, and then you feel a little bit pigeonholed in your travel and the cost goes up. That seems like the biggest takeaway from that article to me in the story is how do you get more air traffic controllers so this can become an easier process?
I mean, they can't work from home, right? They have to go to the little tower. So I guess that's one of the things. Can you work from home? I don't know.
Yeah, labor shortage, pilot shortage, obviously a number of headwinds. I don't have any cool vacations booked this year. Do you guys do for this summer? Anyone going to Europe? Did anyone?
Not going to Europe.
I want to go to Europe in the fall. That's my plan.
I feel like Praz is a safe European trip.
I'm going to Asheville this
I
weekend.
passed.
Asheville.
There we go.
I passed on a Europe trip because the flight was too expensive.
Yeah, I would too. I'm not paying $1,100
$3,000 to fly to Greece from New York.
Wow. And what? And like this weekend?
No, in
A
August.
couple of, okay, all right. Well, that's a lot of money.
Summer is too much of the high season in the summer.
All right, Allie, Josh, and Praz, thanks so much for jumping on here for that. Well, coming up next, Abercrombie's strong earnings report. The stock surging today after topping the street's expectations. Yahoo Finance executive editor Brian Sazi sat down with CEO Fran Horowitz. We'll show you that interview on the other side. Here's some breaking news. NVIDIA out with its earnings report. You're looking at shares popping just about 15% in extended trading. A very strong report from the chip maker. Revenue and adjusted EPS beating the street's expectations. Also strong guidance for its second quarter revenue. Getting into these numbers, NVIDIA is seeing its second quarter revenue of just about $11 billion. The estimate from the street was $7.2 billion. So a very strong guidance number here, clearly showing that NVIDIA is getting a boost from that AI boom. When you take a look at what we're just seeing for the first quarter, revenue coming in $7.19 billion. Estimate was for $6.5 billion. So a big beat there. Adjusted EPS at $1.09. When you dig down into the revenue numbers, data center revenue, $4.28 billion. The estimate was for $3.9 billion. Gaming revenue also coming in better than expected. So clearly NVIDIA, with shares are already up over 100% since the start of the year, adding to those gains in extended trading, with shares popping just about 15%. Another big winner, Abercrombie & Fitch, shares surging today to the upside on today's trading session after reporting a surprise beat on earnings and raising its outlook. Our very own Brian Sazi had the chance to speak with Abercrombie & Fitch CEO Fran Horowitz to dig deeper into these results. Let's listen.
Yeah, super exciting day here on campus, Brian. It's great to see all of the smiling faces and all the energy that we have going here. Abercrombie particularly up 14%, which was growth on top of last year's 13%. There's so many exciting things happening in that brand. I'm trying to figure out where should we even start?
Go with cargo pants.
Start with cargo pants. Okay. Cargo pants are important, but what's really exciting about Abercrombie is that we've really changed the brand from what people used to reference as a t-shirt and jeans brand to a lifestyle brand. And the consumer is coming to us for so many more categories today, which is really what's driving the momentum in our business. You know, the turn started a couple of years ago with the women's business, where we got that going first. Now our men's business is also very good. Our third consecutive quarter of growth for men's, 11th consecutive double digits for women's. But we can talk about all sorts of categories. Dresses all day long. She's coming to us for all sorts of occasion dressing. The men, guys and girls are both coming to us for pants. That's a fun conversation because that's kind of a new trend to this consumer. Now that they're back at the office and they're trying to figure out what to wear to work, they're coming to us for that as well. So lots of exciting things happening.
Fran, you must have read my notes. And as you know, we've known each other for a while. I'm an avid earnings call listener geek. I love earnings calls. And to that point, I love what you mentioned on the call about people going back to the office. And is Abercrombie & Fitch, that brand, is that the new wardrobe? And I mean, what are people wearing to the office again?
Isn't that exciting though, Brian? I mean, to your point, right? People never thought of us as an opportunity to go back to the office, and now they certainly are. They're probably not necessarily wearing suits to the office, but they're certainly wearing something more dressed up than they were doing during the pandemic when they were working from home. So our pant business, our non-denim business is just off the charts. We've got a franchise in the women's business called the Sloan Pant. You see it all over TikTok. We keep producing it in all sorts of fabrics and colors, and she loves it time and time again. And in the men's business as well, we're selling trousers and pants that they can wear to the office.
This is a major fundamental shift in the economy and society, people going, humans back in some form of office setting. Look at me, I'm back in the office here at Yahoo Finance every single day, and my wardrobe is in fact changing beyond the suit that you're wearing now. I mean, as a merchant and heart, Fran, does that change how you plan your assortment in the back half of this year? Should we see more wear-to-work apparel from Abercrombie & Fitch?
Well, I think a couple of things. I think, first of all, to strike a balance in your assortment is the most important thing. Everybody on campus knows my favorite word is balance, and just making sure you don't ever lean one way or the other, because even with people going back to the office, Brian, they're probably not going back 5 days a week. They're probably going back, 2 or 3 days a week. So there's an opportunity for us to service them on the more casual days, as well as those days where they're back in the office.
I thought the customer that shopped Abercrombie & Fitch, and we'll talk about Hollister too as well, I thought they were economically challenged.
We have been seeing a very strong consumer on the Abercrombie brand all through last year and certainly through the first quarter. We're also very pleased with our kickoff to the second quarter. So we have not experienced that. But what I will tell you is, the customer has a choice on where to shop, and they're choosing us because what we're doing is working.
What about the state of the Hollister business? I know you continue to try to round the corner for that brand. What may be holding it back because sales were under pressure?
Yeah, so it's interesting. I'd love to take you on that journey for Hollister. So last year during the second quarter, we saw a step down, just like a lot of the other teen brands did as well. But what we did was we said, how much of this is us and how much of this is macro? And we found some opportunities for us. So we've been on a journey to really evolve our assortments and get back to being close to that customer. We've worked on our assortment architecture. We've worked on our assortments. And what we're seeing is as we've pivoted, out of being predominantly denim as an example, non-denim bottoms again are working. Dresses are working. So the top line was disappointing, to your point, but the bottom line wasn't. So we're back to profitability. We actually were able to raise our AUR, which is a good sign that the brand is healthy. And most excitingly is our inventory is under control. So we're down 20% as a total company and even more with Hollister. That has brought back one of my other favorite words, which is chase. And the fact that the team can now chase goods and react to the business is a big win for us.
Well, okay, maybe some green shoots in Hollister, Abercrombie & Fitch brand firing on all cylinders. If you had to place a guess, how do you think the key back-to-school shopping season will go for your company?
I'm looking forward to back to school, especially since we've evolved all the assortments. So we'll start to see, the end of Q2 and in the third quarter, we'll see. But I'm looking forward to it, and I'm excited about what we have for the consumer.
We've heard a lot of retailers call out this earnings season. Consumers are trading down. Are you seeing that in your business?
We are not seeing in it. We've seen AUR increases, interestingly enough. We came out of the pandemic. We have had double-digit AUR increases through 2020 from pre-pandemic. That is something we tried to do pre-pandemic for many years and couldn't accomplish. Our goal coming into 2023 was to hold on to those AURs. And in fact, we beat them for Q1 and in both brands.
I know we have talked many times through the years on how you continue just to close underperforming stores. You're opening new stores, but given all the concerns in commercial real estate with interest rates, are you getting any higher rents? Are some of these mall players trying to raise rents on you because of challenges they are in fact seeing?
I mean, we have two very strong global brands, so we are very desirable in the malls. To your point, though, we've been on a stores journey for a very long time. It started with a lot of closures, and now we're being back to a net store opener. So in 2022, we were net store opener. We plan to be one again for 23. But the most important thing for the team is to make sure that we find stores that are the right size, the right location, and the right economics, and we don't budge on that. So if the deal doesn't work for us, we pass and we patiently wait until we can get the deal that does work for us.
How do some of these newer stores you're opening compare to the stores that are already in the ground, whether it be Hollister or Abercrombie & Fitch?
So both are much smaller. What we have found is that these smaller, more efficient formats are definitely working for us. Some exciting new things that we're doing in Abercrombie is that we're opening up street locations. We opened up a couple in Chicago last year that have been absolutely terrific. We just opened one up on Newbury Street in Boston. We have a few more planned for the balance of the year in some key cities. So again, listening to the customer and understanding where our consumer is, we're always testing and learning and trying to find new opportunities.
One thing we have been tracking here closely here at Yahoo Finance, Fran, in retail is inventory shrinkage or theft. Does this apply to your business? And then what are your contacts saying in the industry? I talked to the folks at Target. They're calling out a $500 million profit hit this year because of theft. I mean, do you see that in your stores? And have you had to put extra security in your locations?
We've been very fortunate. At this point, our P&L, we always have to reflect some shrink because it's all part of, of what we do. But we have not seen a spike in it at this point.
That is certainly a good thing to hear. And I will, last question for me here, Fran. What is the biggest challenge you're up against this year as a leader? We have concerns about a debt ceiling. We have inflation that seems to be benefiting you a little bit. That's starting to come down. That's a good thing. But how do you think as you try to formulate your plan for the back half of the year, what are some of the things you're up against?
Yeah, I guess when I step back, Brian, I think about the last 3 years as a CEO. Anybody that has sat in this seat is honestly ready for anything and everything that comes at us. It's taught us how to be incredibly agile and really ready to pivot on any opportunity. So there is a lot out there, to your point, a lot of macro things that we're not sure about, but we're ready to compete. We've got our inventories under control and we're controlling what we can.
Abercrombie CEO Fran Horowitz speaking to our Brian Sazi there. Well, Noom is just the latest company getting into the weight loss drug business, announcing today that users will soon be able to get prescription obesity drugs through its new Noom Med offering. Let's bring in Yahoo Finance's senior healthcare reporter, Anjali Kamlani, who's got the details. Anjali, we were talking about how this kind of feels like a pivot for Noom, which has always been about sort of healthy body image, focused on exercise and food. Now they're getting into the medical side of things.
That's right, and more heavily so with this offering. So they previously did have a relationship with Novo Nordisk back when Novo had their other GLP drug, Saxenda, and they had a partnership going with that. But this really falls into the category of what we've seen, which is a significant shift of companies like Noom. We also know Weight Watchers joined, as well as other telehealth platforms like Ro as well. So we're seeing this shift of companies that have previously touted or looked at other options like behavioral and lifestyle changes, dieting, monitoring calorie intake and the like, and really pushing, as well as exercise, and then pushing now for including these GLP-1 drugs like Wegovy, Ozempic, and the like as part of the process. Now, it's important to remember that Wegovy is the only one that is approved for weight loss in addition to Saxenda. There are also type 2 diabetes drugs. We know Lilly is going to be coming out with Mounjaro as well. And then we've got another one, Contrave. That's another one that Noom is going to be able to offer. So all of these are on the table as options for those patients and those members. It's something that we're seeing growing in popularity, of course, as more attention falls on this class of drugs.
Nanja, when we talk about the growing popularity of this and the trends that we are seeing, there is one potential challenge here, and that's the fact that some of these employer-based healthcare plans don't want to pay for these drugs. What's behind that?
So that's actually been something that we've seen, including with Saxenda, like I mentioned before, for Novo Nordisk. We've seen that when it comes to weight loss coverage, these insurers don't want to, in part because then it falls into the category of a lifestyle drug, and that's something that they've generally pushed back against. Take, for example, Viagra as another option. And that's something also, that's another pill and another time and an example in which the pill was used for something else, or initially, came out for one indication and is started being used for another. So similarly, these are type 2 diabetes drugs now being used for weight loss. And so that's where the concern comes for these companies, for the insurance companies, for these employers, because they've already started to see skyrocketing costs when it came to the use of these drugs before they started pulling back. So it's something to keep an eye on for sure. Maybe there'll be, more efforts to put this in play. Maybe we will get coverage for it, but it's definitely something that has a lot of lobbying going on right now.
Yeah, I can imagine. Anjali Kamlani, as always, thanks so much for that. Well, shares of NVIDIA seeing a huge pop in after hours here, up 18.5% on the chip company releasing its Q1 earnings report. We're going to take a deeper dive into those numbers on the other side of the break. We'll be right back. Well, shares of NVIDIA are surging in after hours here after first quarter earnings came in better than expected. For more analysis, we turn to Angelo Zeno, CFRA Research Senior Equity Analyst. Good to talk to you today. Overall sales, we should point out, fell a quarter compared to year on year. But this is all about the forecast here and so much optimism riding on NVIDIA's data center business with AI.
Yeah, you're absolutely right. So on a year-over-year basis, I mean, you're talking about a revenue decline, I think, of about 13% or so. And to maybe put it into context, that's lapping essentially an all-time high in terms of their gaming revenue, in terms of peak gaming demand. And so when you kind of take that into context, overall, I mean, the numbers for the quarter were pretty good. Data center grew about 14%. We're looking for growth of about 4% or so. And on the gaming side of things, the losses, I think, were down about 38%. We were looking for a decline of about 45 to 50%. So overall, the quarter came in pretty good. But yeah, make no mistake, this is all about the guidance in terms of that 11 billion revenue number and kind of what some of these cloud players are doing in terms of the investments on the GPU side of things as it relates to their data center business. And clearly, there is a shift taking place within the semiconductor industry where a lot more content and dollar spend is going towards GPUs and away from other type of, infrastructure type related investments like storage, for instance, because of kind of all this hype that's going on in the AI side of things.
Yeah, Angela, where are we in the innings of AI? Are we still in the early innings? And when it comes to obviously NVIDIA's first mover advantage there, what does that moat look like?
Yeah, listen, I think when we think about AI here and what inning we're in, I mean, clearly we're in the early innings, right? I mean, I start thinking about kind of, what Alphabet's done with their TPUs, their kind of internal application-specific chips, and that's been out for about 6-7 years. So these companies have been investing in AI for several years now. So we're not necessarily kind of, this isn't anything that's necessarily new for a lot of these cloud players in terms of their investments. We've seen a number of products kind of rolled out here in terms of what Microsoft and Alphabet are doing. I mean, it seems like every single day there's kind of something new coming out on that side of things. So when we kind of think about the trajectory here, I'll put it maybe this way. I think NVIDIA has kind of a very clear pathway in terms of significant revenue growth, not only here over the next 12 to 18 months, but over the next decade. And it's not only going to be driven by kind of AI and data centers, but it's clearly going to be driven, with AI across kind of, all end markets, whether we're talking about autonomous capabilities when we kind of look out towards 2025, 2026. But they've got a lot of legway here to really see significant growth, which is going to be driven by kind of more AI capabilities. Again, not only inside the data center.
Angelo, it feels like the excitement around AI has kind of overshadowed the concerns that we had with NVIDIA and potential restrictions on the Chinese market. Now, we heard from Jensen Huang talking specifically about cautioning lawmakers against additional restrictions, although there's some already in place. Where do you put that in terms of the risk for the company right now?
Yeah, listen, I think the numbers probably could have been even better if we had kind of, if they had unlimited access to all geographic regions and the ability of them to, sell their H1s, but H100s. But, to some extent, it's also, to some extent supply constrained in many respects, or at least we think so. So, as far as kind of the risk for China are concerned right now for NVIDIA, I don't think it's necessarily a big deal because of where we are, in terms of the cycle. That being kind of closer to the bottom of the cycle and some of the more consumer-driven type end markets. And then, of course, the opportunities just here in the U.S. and Europe as far as kind of the AI opportunity is concerned on the data center side of things. So it's probably not something that's impacting the company right now that much. But as we kind of start thinking about the long-term opportunities out there, China is, of course, a critical market out there. You've got some major cloud players out there, whether we're talking about the Tencents, Alibaba's, Baidu's of the world, and clearly NVIDIA wants to be part of kind of the evolution of those companies. So it's important. It's not necessarily something that's going to impact the numbers here over the next 6 to 9 months, though.
Angela, you just raised your price target from 300 to 350. We're trading in after hours. We're actually above that by $15, right around 365. Are you going to revise your outlook here? And what do you think that growth number potentially looks like?
Yeah, listen, as far as when you look at the actual forecast here of about 11 billion, I think was the number. I mean, you're looking at a growth pace of north of 60% here for their July quarter. And that's absolutely phenomenal when you kind of look at what the expectation was, and that it was about 7% top line growth. Our view was you were going to see something along the lines of 30% top line growth as you were going to exit the calendar year. Clearly, that number is going to look a lot more favorable, at least in our view, given what we're looking at in the July quarter. I think what we need to find out first off on this call is how sustainable is some of this kind of near-term demand? Is some of it potentially being pulled in or not? And as we kind of get more clarity on that side of things, I think we can kind of come up with better assumptions here in the second half, in the second half of the fiscal year, as well as, more importantly, into fiscal 25 and beyond.
TFRA's Angelo Zeno, good to talk to you today. Incredible run we're seeing, at least in after hours here for the stock. Well, coming up, we're going to tell you about some of the biggest after hours movers on the other side of the break. Stick around.
Let's take a look at what's trending after hours. 4 names for you here. Starting off with NVIDIA. You're looking at a gain of just about 20% in extended trading. A very strong report here from NVIDIA. Also strong guidance is what's driving this stock higher. When you take a look at some of these numbers, revenue coming in $7.2 billion, adjusted EPS of $1.09, both better than what the street was looking for. That 2Q revenue guidance of $11 billion. That was surging past Wall Street's estimates of just over $7 billion. Clearly a sign that NVIDIA has benefited from and expects to continue to benefit from the AI boom. You're looking at gains of just over 100%, 109% since the start of the year, although, of course, that follows what was a relatively challenging 2022. Over the last year, you're looking at a gain of just about 90%. Moving on to Snowflake here, a totally different story. You're looking at shares off just about 12.5% here. The company missing the street's expectations, product sales outlook falling short, suggesting that some companies out there are cutting back on their cloud spending. Obviously, a massive headwind here for Snowflake. Also, product sales make up a majority there of their revenue. Over the last month, the stock has actually had a relatively strong one following the results that we got, the cloud results from Microsoft and Alphabet. So we're seeing it give back about half of those gains here in extended trading. Obviously a name to keep on watch for tomorrow's opening bell. Moving on to e.l.f. Beauty. This is a name that has outperformed by a wide margin here over the last year, looking at gains of nearly 11% in extended trading, up over 300% in the last year. Another strong report here from the company. Net sales beat, adjusted EPS coming in better than expected. Also, full year sales guidance blowing past expectations. Putting this all in perspective, this is the 17th quarter in a row from e.l.f. that we saw net sales growth. The CEO saying that they're still just in their innings of unlocking potential. Again, 1 year growth of just about 300%. And rounding it out with American Eagle Outfitters there, another retailer disappointing the street, falling just about 15%. We're looking at huge moves here in extended trading. Forecast for sales to decline in the second quarter. That's a big driver of the after hours action. The company saying that ongoing macro challenges, that of course is weighing on the company, obviously having an impact on their guidance. They also see their full year operating income below the street's expectations, now seeing $250 million to $270 million. That was lowered from their previous estimate. Over the year, the shares are essentially flat, but year to date, taking a look at that chart, stock off just about 13%.
Well, it's closing time here at Yahoo Finance. Let's get you caught up on some of the biggest headlines of the day. Stocks ending the day lower across the board. The Dow shedding more than 250 points as investors wait for some sort of indication from Washington on the status of a debt deal. JP Morgan economists estimate there's now a 25% chance that negotiators will not reach a deal to lift the debt limit by the so-called X date, which is the date the government will no longer be able to pay its bills.
NVIDIA's first quarter results handedly topping analyst expectations, but it's the guidance that has investors very excited here. NVIDIA estimates Q2 revenue here will come in at about $11 billion, plus or minus 2%. Wall Street was expecting $7.2 billion.
And finally, Meta is undergoing its third round of layoffs, this one focusing on the company's various business groups. It's part of the tech giant's plans to cut 10,000 jobs. It's part of what CEO Mark Zuckerberg is calling its year of efficiency.
That'll do it for us today on Yahoo Finance Live. Thanks so much for hanging on here. We will see you right back at 3 p.m. Eastern Time tomorrow for all your coverage leading up to and after the closing bell. See you then.